Okay, so let's dig a little deeper into this thing and really explain how verticals work. So remember again, our stock price is $12.55 and we're selling a call vertical. So we started out by first selling the $12.55 call. And remember, if we just sold that by itself, we'd have this undefined loss potential. But to protect ourselves, we're going to buy the $12.60 call. And when we do that, we're getting a credit of $2.35, which we all know options are times 100, so it's actually a $235 credit when we sell this vertical. So what does that mean? Well, let's go up here now and see how this defines our risk. So our defined risk formula is our max loss is the difference between the strikes. And what is that? Well, in this case, our strikes are $12.60 and $12.55. So the difference between those two is $5. And remember, everything in options is times 100, so the difference between the strikes is actually $500. Minus the credit received. What did we receive for selling this? We sold it for $235. So let's look again. Our max loss is going to be the difference in the strikes minus the credit received, which in this case is $235, which means our max loss is going to be $265. And if you look right here, you see it play out exactly as we've just broken it down. Our max profit is always what we sell it for, just like selling an option by itself. The most you can make is what you sell it for. Same with the vertical. The most you can make is what you sell it for. We're selling this thing for $235, which means the most we can lose, our max loss, is $265. And again, how do we work that out? It's the difference in the strikes minus the credit received. Difference in strikes, $12.60 minus $12.55 gives us a $5 difference in strikes, which is $500. Difference between the strikes minus the credit received gives us a $265 max loss. So you can see we've defined our risk, and if you look down here, our POP is still greater than 50%, which we love to see, right? So yes, it's a lot less than it was for the naked option, which was the 65% roughly, but in this case we're still above 50-50, and we're defining our risk here. So instead of this undefined number here, now we know the most we can lose if things go horribly wrong is $265. And again, this plays out into our rule number one with trading, which is if you can lose more than you can win, which you can in this case, right? You can lose $265 and the most you can make is $235, so you can lose more than you can win. Our POP has to be above 50%, and it is. It's 53 in this case. That is basically selling a call vertical and how it's broken down.